Welcome everyone to our first webinar of 2026 for FI Live. My name is Leslie Mondesir. I am the Member Solutions Manager here at the bank, and I am joined by Drew Simmons, our Oklahoma Regional Account Manager. The format of the series today is going to be consistent with webinars past. We'll talk about the economy, some trends, what's going on with the peers across the district, liquidity and funding strategies, along with some tools and products that may be available through your membership with the Federal Home Loan Bank. A couple of housekeeping items. This webinar is being recorded. You will receive a copy of the slides with a replay link following the webinar. You can use the Q&A to submit questions. We will get to those at the end or as we go. There is one CPE credit available today, but you must participate in all the poll questions to receive that credit. And with that, we will go to our first poll question. Well, the one before this. Which area of the webinar are you most excited to hear about today? I mentioned the economic update and member financial trends. Also, we'll be providing a quick overview and timeline for our housing and community development programs. And we'll be highlighting our 2026 annual member conference that will be in the middle of April, and I'm sure most of you have received emails about registration for that event that we put on for members. So I think we've got most participants here. Give a few more seconds, and then we can go ahead and end the poll. And we will I will turn it over to Drew, and then we will move into our economic update, which will start with another poll question about rate expectations. Drew?
Thank you, Leslie. Okay, so obviously next month we have another Fed meeting. What are your expectations on potential rate cuts at their next meeting? We just came off a pause. Do we think we'll revive rate cuts by 25 bips for selection A? Yes, maybe by as much as 50 bips. C, no change in the Fed funds rate, unchanged there, and D, potentially a rate hike. So go ahead and put your selections in there, and we'll share the results here shortly.
And we need to launch the poll. There we go.
Okay, so we all track this, right? It's not really much to be surprised there based on Fed funds futures. We're always talking with our counterparts, tracking the markets, and most of the futures markets believe that there will be no change in the Fed funds rate for the meeting next month. Potentially, maybe that will pivot. Keep in mind, there has been a lot of volatility, more so in prior Fed meetings leading up to it. We start with one direction, and all of a sudden things change, highly volatile market. So plenty of time, even though it doesn't really feel like it because it's just here in a couple of weeks. But either way, right now, most of you are accurate insofar as the rest of the general populace consensus that there will be no change in the Fed funds rate. Okay, so just a couple of highlights that I'm going to cover here for you guys on the economy. Again, the rate cut projections less than 10% right now. Okay, as I've done before, these red and green arrows really just kind of what we might expect from a benefit to our members, right? We want to see lower cost of funds for our members, and certainly the Fed funds rate tracks with our advance rates, especially on the short end. That would definitely help our members from a cost of funds perspective, especially considering that the long end of the curve is still relatively sticky. So we have a good margin picture when we look at the overall yield curve, which we'll cover here in a little bit. GDP has come down a bit, 3.7%. It's good that it's coming down from a overall, running too hot perspective, considering the inflationary environment we had over the last few years. But we don't want it to come down too much, right? There's a happy medium here. Core PCE, so inflation has been coming down. Slowly and surely, it has been coming down. And we're now seeing core PCE at 2.8%. last Friday, we got a pretty healthy print from core CPI all the way down to 2.5%. The Fed's preferred measure of inflation is core PCE, but core CPI differs, marginally there. And so any indication that inflation overall is coming down, especially the core measures, is certainly a positive for depositories and our members. Unemployment rate also has been tracking down, and we want to see that as low as possible. But there are some, issues with the labor market that we'll cover here in a little bit when it comes to openings, when it comes to a touch of an increase in layoffs. HPI, which we certainly track on an ongoing basis, home price appreciation has been coming down. The big issue, of course, with housing right now is supply. It's just really difficult to see homes move, both on the new builds and existing home inventory. Homes are just simply not moving. That's a large product of the rate environment that we had, where you have these very, very low rate home buyers that it's difficult for them to transition, unlike prior markets where it didn't really make as big of a difference insofar as their overall budgetary plans when making those types of decisions. One of the kind of highlighted chart I have here for everyone today, defaults are continuing to rise. It's been a slow sort of bleed in this space, but right now we're seeing defaults the highest since 2017 COVID era. Naturally, we saw a spike in the COVID pandemic and the loss of jobs, although temporary, it didn't last long. What I'm most concerned about here, though, is that this sure looks a lot like this market here. And what is that? 2008, right? That was where the '08 crisis was sort of born. And, you don't really see the absolute peak in defaults until many years after a major, financial crisis or some sort of event that does trigger a recession. It takes a long time. Consumers, as we all know, have the resources to be able to sort of kick the can down the road quite a while. Surprisingly, even for those that have been in the financial markets for years, it is usually surprising how long folks can last on what I call full tilt, right? And that's just, we don't see the aggressive amount of borrowing to those that don't have necessarily the good credit profiles. But those that are experiencing the default, it has been on the rise. So that's certainly something we want to track going forward. Okay, so like I said, only a 10% chance as of last Friday for a Fed cut. And you can see in that red box that I've highlighted for you, the odds at the upcoming meeting. So, whether or not, we have to sort of address the elephant in the room here, which is the politicization of the Fed, or the attempt to do so by the current administration. I get that the current administration would like to try and, engage more with the Fed and try to encourage them to lower rates to help borrowers out there. But the Fed, does still need that independence. And so there's certainly some strife there, as we've seen. And, with a new Fed chair and all those changes, I think that's a lot of what's driving the volatility and constant whipsaw nature of, hey, are they going to continue to cut it? It sure felt like leading into last year that, we were on a more traditional Fed easing policy, that there were some, constraints in the labor market, that it was time to start more consistently moving down the Fed funds rate and more, trying to get maybe a little bit more purchases in the longer end of the bond market to try to lower things like mortgage rates and such that affect the average consumer. But I think there is certainly a lot of politicization that's going on that has created a lot of uncertainty with where the Fed funds rate will land. Again, insofar as GDP, quarter four final estimate came in at 3.7%. Quarter three came in at 3.8%. Quarter four, according to the Atlanta Fed's GDP Now, which has been pretty accurate over the last few prints, at 3.7%. What's interesting is that the blue chip consensus, so just a consensus of folks that are surveyed there, has increased pretty sharply over the last a few prints here on the year. So, the range was kind of a 0 to 1.5%, almost all the way through last year. And now it's moved up sharply, but the range is also pretty wild, 1 to 4%. So a lot of more uncertainty there. But as of now, GDP is still very strong and has been coming down. Inflation cooling, like I said, we like to see this core CPI number coming down from the peak of late 2022 of around 6.5%, where inflation was running very, very hot from an ultra low level in the COVID era, but has steadily come down to 2.5%, which is a good thing, because if you look at the last time we've seen a 2.5% core CPI, it was the beginning of 2021. Inflation hadn't really started its run until late that year and into 2022 before it peaked out. So it's been steadily coming down. There is a lot of fits and starts with the inflation. There's certainly a lot of inflation in certain pocket areas, especially at the grocery store, and things like that. Shelter is still a problematic component of inflation, but net, it is coming down. We do want to continue to see that. And real earnings, so net of inflation, right? Real earnings, when adjusted for the inflation figures, it has popped back up recently, 1.9%. We had a level like that in March of last year, but really we haven't seen that going all the way back to May, March-ish of 2021. So that is good, but again, I'm going to cover here in a little bit some of the more problematic issues that we're seeing when we dive into the data of the employment sector. So real quick, let's just talk about the Treasury market, talk about rates, talk about the yield curve. I took these screenshots Friday of last week. I just checked before this webinar started. Rates really across these next three charts have not really materially moved, maybe a couple of basis points, but the trend is really what I want to highlight here. And so the yellow highlight that you see up here that occurred in the spring of last year, May-ish, in the 3-month Treasury bill, and that's going to track a lot of our advance activity. Naturally, as you see rates start to fall, our members are going to shorten up their advances, shorten up their duration. They don't want to extend their liabilities in an environment where they're anticipating lower rates, and that's been occurring. We went from about 4.4% in the 3-month Treasury bill again last May. We're now down to about 3.68%. That's down 71 basis points. Moving on to the 10-year, about that same time, more late May with the 10-year, peaked out at about 4.6%. Recent trading activity has it all the way down to about 4.06%. That's down about 54 basis points, not quite to the terminal lows that we saw in this cycle in late last year and at the end of last year, but it's certainly trending down. The 30-year, the long bond. Again, late May, early June, we saw it clip out around 5.1%. Recently has come down to 4.7%. The overall takeaway is a bull steepener, right? Overall, all rates are really coming down slowly and surely. There's been some fits and starts, certainly, but overall rates have been coming down, but the short end much more dramatically, right? 39 basis points down on the 30-year, 54 basis points down on the 10-year, 71 basis points down on the 3-month. That's good for margins. We want to see that. We're talking with a lot of our counterparts in the ALM space. We're talking to economists and saying that's good for banking. That's good for depositories. We want to see that our cost of funds are, pretty low or coming down consistently, and yet our asset yields that are generally on the longer part of the curve are higher. So that's a very positive environment for banking. But keep in mind, when that happens, historically, the classic preface that you have to give here, past performance might not be indicative of future results, but, historically, it certainly lends to then a kind of a bull flattener where rates do continue to come down, but then the long end starts to catch up and the long end ends up flattening the curve. That we don't like for margins because, you don't see much difference between the short end and the long end. So take advantage while you can. We've surveyed our members over these last few months. The environment is still very healthy, even though the macro level does show a significant increase in defaults. We're not really seeing that in our region as much. We don't see as much consumer lending. I think that's also what's driving that, especially with our commercial banks. Credit unions are certainly seeing a little bit more of that insofar as their retail accounts. But what generally does follow this bull steepening is a bull flattening. And as we covered in our last webinar, just some strategy thoughts leading up to that, looking a little bit ahead, is to try to sort of anchor in some of those asset yields before they go away. There's a number of ways you can do it. And the article, I don't think you can click on this live, but we will be sending out a PDF version of these slides today, and it will have that live for you to click on it. So if you haven't had a chance to review that article that I penned late last year, you can do so, but it's talking about, these types of strategies to anchor in some asset yields. Liquidity is still pretty tight for most of our members. And so the first, hesitation when it comes to trying to maybe buy bonds on the interim part of the curve and anchor in some of those yields is, hey, look, every single dollar of liquidity we have right now is tied to the loan portfolio. And we see this as very, very consistent along the liquidity cycle, where it's very difficult to try to diversify those assets into bonds and other things that you can try to take advantage of these types of yield curve environments. So, a counterpoint to that, or a way to alleviate that stress, is to utilize our advances, and to do so by matching those advances to the cash flows you already have coming due to you in a relatively short amount of time. When it comes to a leverage strategy, meaning you're using FHLB advances to buy bonds in this example that we gave, you're not going to ever get a duration match, right? You're not going to be able to say, hey, let's buy a 5-year average life mortgage-backed security and match it to a 5-year bullet advance from the home loan bank. That is not going to get you the yield that you want. But you also could just borrow short, and then now you're left with, well, what happens when the borrowings are due? And what's that going to do to my liquidity profile? So again, one way to alleviate that, we address this in the article, is to say, okay, well, if you have, let's just say in this example, $10 million of cash flows coming off of the existing bond portfolio, or other cash flows, anything. Look at your ALM reports and identify those cash flows that are coming due. Match those with some borrowings, and so you're fully paid off of those borrowings from cash flows that are guaranteed to come back to your institution in the coming 9, 12, maybe even 18 months. So keeping everything pretty short, where the curve is advantageous to do so on a borrowing perspective, locking in those yields, and then you've got them all paid off due to those cash flows that are coming back. So this chart down here below illustrates that. It kind of goes through it in the article. If you have any questions, certainly reach out to me or Leslie. We'd be happy to answer that. Any questions that you have, or give you some anecdotal examples of folks that have been executing the strategy. But again, when you look at prior cycles, we do see that these types of strategies can definitely help protect against that exposure to falling rates. So if your institution generally does better in a rising rate scenario, this is insurance to try and protect against that potential falling rate scenario. If interest rates go up, your balance sheet does better if you are in that camp. A little over half of our members are in that camp. And it's just simply insurance. We're not talking about wholesale moves here, just some small, single, double kind of base hit plays to protect the overall balance sheet. Okay. Whole question here. I'll go ahead and open it up. What are your expectations for the health of the labor market in 2026? A, no material changes, kind of steady as we go, not much of a change. B, marginal improvement. C, significant improvement. D, marginal deterioration. Or E, significant problems in the labor market going forward. Okay, give it a couple more seconds here, let you guys filter in with your responses. Like we have a few more coming in. Okay, I think we're good there. Oh, got a couple more. I'm holding. All right, you got just enough. Okay, let's go ahead and share those results. Yeah, so most of you, it's close. 37% of you folks on the call today, no material changes, and another 35% marginal deterioration. So either we're going to be steady as we go, or we're going to see some problems in the labor market, just some slight problems if these poll numbers are accurate and they do end up playing out. So that'll be interesting as we go forward. Again, the unemployment rate's good, but we are seeing some slight problems in the pockets of the labor market, which we'll go into now here in this next slide. So what you're looking at here is just a Bloomberg chart showing the JOLT survey that came out recently. The red line there is layoffs, flat line. That's good, right? We don't want to see a big pop in layoffs. So this is the no hire, no fire scenario that we're talking about. And the no hire is that green line, the JOLT survey on job openings. So while we haven't seen any issues when it comes to layoffs, significant layoffs, the Challenger survey late last year showed a random spike in that. It could be a problem with the data due to the government shutdown. That certainly caused a lot of disruptions. But right now we're more in a normal economic data release schedule. And while again layoffs are very, very low and really not in getting any sort of spikes there, job openings are problematic, and they're certainly coming down. So if you're looking for a job, not great. If you have a job, no problem. And if we start to see an inversion here where that red line starts to pop up and the green line continues to go down, that's where things could be problematic going forward. Okay, as I mentioned before, delinquencies, I kind of already covered this, but yeah, we're seeing a steady increase in delinquencies on the low end, meaning those 30-day late folks. Oh, that could be some noise. But man, when you start to get into severely derogatory, outside 120 days past due, these folks are not okay. And that green section there is certainly a significant portion of the overall share of delinquencies. And again, as I mentioned earlier, it looks a lot like leading up to the peak in defaults that we saw in 2010. Hopefully we don't get there. It would be obviously a very bad scenario for the overall economy. Fingers crossed. Let's say it just moderates, or hope. And again, when we've talked to you guys, we're not really seeing it on our balance sheet, so it's great. Maybe there's some insulation that we have given our region, but it is trending in a direction that we need to monitor going forward. Okay, last section, I'm going to talk about the economy. I know if any of you guys have been to any conference over the last year, AI has been all over the place. So I'm not really going to go crazy on this, but I do want to talk about the economic impact here, specifically when it comes to the labor market, because I get a lot of different feedback from our members when I go out and see you guys here in Oklahoma. But what do you think? I mean, you're starting to filter in here with your comments or your impressions, but do you think it'll be no impact, positive impact, or a negative impact? Most of you are coming in with your responses here, and yeah, we're about done. We can go ahead and share that. Yeah, almost half of you, negative impact. Look, I'm not going to get into too sci-fi wild scenarios here, but this type of technology does feel different. It really does, and there's a lot of concerns, especially in our neck of the woods, when it comes to the labor force. Everything from white collar jobs to blue collar jobs. It's all over the space. And I got to even say, from a personal level, I'm a big music fan. I've been a jazz drummer most of my life. And when my kids play some sort of artist that they like on the streaming platforms, and I even barely detect that it's an AI band, it drives me crazy. So AI has even impacted the arts. So yeah, it'll be very interesting to see what happens. This is a chart over here to the left that I talked about in our last two webinars last year. The share of AI growth when it comes to GDP and improvement is massive. It's absolutely massive. And if you can see that here in the right portion of this graph, very similar to the dot-com bubble. So there's an argument to be made that while AI might have a major impact to the overall economy over time, it also might be overblown insofar as so many folks are chasing this AI thing I always ask though, how are you chasing? Yeah, I know at our bank we're certainly looking into ways to improve efficiency, and we all use it on a very regular basis, just on the consumer level, and that's what this chart over here to the right highlights. Is that most Americans say they interact with AI at least several times a week. I kind of was hesitant initially, and I've started to use it more and more. I know my wife does with her, what she does at the hospital. We talk to so many different sectors using it more and more. So it is growing, and it is growing quick, and that's certainly representative of the share of GDP growth that we've seen. So let's just end here with just an overall let's take a step back and say, what are the positives and the negatives here when it comes to the impact of the labor market? And there's an article down below that I've sourced. I'd highly encourage you to look it up by The Atlantic. Really does a big, deep dive on the potential impact here. But, insofar as the negatives, there was a recent poll by Reuters saying 71% of respondents are worried that AI will put too many people out of work. Our poll that we just did, kind of a similar thing. Most of you guys think that this is going to be overly negative for the labor market. CEO of Anthropic, AI could drive unemployment up to 10 to 20% over the next 1 to 5 years. CEO of Ford, Jim Farley, AI could eliminate half of all white-collar workers. So, the rush to AI, could be a problem, like I mentioned earlier, when it comes to maybe similar to the dot-com bubble. So much, sort of fever or fervorish, interest in it, but not really sure how to get there. But it is definitely changing the overall economy. Let's also talk about the positives. And if you look historically, technology in general has had an overall positive impact to the economy in general. In our space, ATMs, the initial thought was, man, this is going to replace a bunch of bank tellers. Actually resulted in more bank tellers. When Microsoft Excel first came out, not as many analysts and accountants. It actually increased demand for accountants. And in the more creative space, Photoshop actually increased demand for graphic designers. Now, the caveat is these are tools that helped the industry. And AI is a learning tool. It is constantly improving on itself. And, while it will, yes, on a positive perspective, increase efficiency and productivity by companies, it also can certainly eliminate jobs permanently. So, but it also can improve work-life balances for families. A lot of folks are more reliant on dual incomes. And certainly my family, we both work, and it's a different environment than what my folks went through when we were raised as kids. And also, just lastly, the big hope here is that there's going to be some forward-thinking regulations on some guardrails within AI, so that way we limit any sort of market disruptions, labor market disruptions. So, all right, that being said, I'm going to go ahead and turn it back over to Leslie, and we will talk about member financial trends.
First, we have one more poll question. I believe, what's your biggest concern? There we go. What's the biggest concern you have for your local economy? Drew talked about inflation, housing affordability, certainly unemployment and the labor market. And then he showed slides on rising delinquencies and what's the biggest concern you have in your local economy. And then a few more are still rolling in, and we will go ahead and end the poll. It's interesting. So when you look at the graph there to the right, we've asked this question since our first webinar, and kind of gauge what's top of mind for our members and their economies. And we can certainly see the shift. I know the poll came down, but there was quite a jump in rising delinquencies. Drew talked about that. It was only 6% of responses in November, 7% in September, and I believe it just said we were up over 30%. So certainly something to keep an eye on and top of mind. Now, Drew, if you want to go into the trends, we'll get started on what we're seeing in the financials of our members. All right, here we're going to look year over year, year-end 24 to year-end 2025. We saw solid growth in balance sheets. Last year, both positive and loan growth compared to 2024. Loan growth continued to outpace deposit growth at our bank members, while share and deposit growth actually outpaced loan growth at our credit union members. And there in the middle of the screen, you can see the differences between larger members and smaller members. For our bank members, that's greater than $1 billion is the black, and less than $1 billion is the light blue. Credit union, that threshold is 500 million in asset size. On the lending side, we had a strong quarter for ag lending activity, followed by CRE lending for banks. Credit union, that lending was driven primarily by residential loans. In aggregate, for our current bank members, we crossed 500 billion in assets and 400 billion in deposits during the fourth quarter. On an aggregate basis, non-maturity accounts saw the most growth for both banks and credit unions. But on a median basis, we're still seeing that mix shift at smaller banks, with CDs growing as a larger percentage of the portfolio. And at short terms, that is not the case with larger banks and credit unions. We've seen a pivot back in the other direction during the fourth quarter. Loan and deposit ratios, they continue to remain elevated, along with the use of wholesale funding to fill that funding gap and support the balance sheet growth that we saw over the last year. We have a flurry of poll questions here, but we have another one looking at loan and deposit growth expectations for 2026. We did ask a year ago, we asked the same question about expectations for 2025, and it was a little bit more heavier or stronger loan growth than deposit growth is what was projected a year ago when we asked the same poll question. That is what we saw for banks. As I mentioned, the bank median and credit union medians are there. And like I mentioned, credit union deposit growth did exceed loan growth, but both were again higher than they were in 2024. And it looks like as they continue to roll in, that loan growth expectations continue to be pretty strong, like they were last year. And deposit growth expectations, not as strong. So they're still going to expect a funding gap that will need to be filled with another source of funding and liquidity. And as we move into the next slide, we look at liquidity and wholesale funding trends over the past 2 decades. Liquidity, will focus on that first, represented by the light blue lines in both graphs. Relatively unchanged again for banks, and the increasing trend for credit unions there in the bottom has stalled a bit. If you look at the components of this specific liquidity metric, liquid assets to assets, not the only liquidity metric to monitor, but this one we're showing in the chart, it's lower, in part from paying down using cash inflows, like security inflows, deposit growth to pay down wholesale funding or to fund that strong loan growth that we did see. Institutions may be getting more comfortable with lower liquidity positions, but the medians are still 13.5% for larger banks, over 17% for smaller banks, and credit union medians are back above that 10% thresholds that regulators tend to focus on. During this time, loans pledged as a percent of assets does continue to rise, so access to funding through secured sources, such as advances, allows for greater operating flexibility. The total liquidity picture has become front and center. On the wholesale funding side, that's going to be the black line in both charts. A higher percentage of members, so number of members, continue to use wholesale funding. We're at a couple decade low of percent of members that do not use any source of wholesale funding. On the advanced side, we did see line of credit balances decline near year end. That follows typical patterns and activity, but we've seen that kind of pivot and its started to climb again at the beginning of this year. Our advance base continues to remain at elevated levels, especially for smaller members. We're seeing a stronger reliance on wholesale funding, particularly advances by our smaller members. We're going to switch to the earnings side. It was a good year for financial institutions, especially if you look at the black line, which is net interest margin, continued margin expansion. That's been great. On the funding side, you can see the blue line. That's cost of interest-bearing deposits. It's been a little bit stubborn, and it's lagged a bit on the way down in adjusting with the decrease in rates. Larger banks had greater betas on the way up, 55% versus 41%. So they have more room to move lower, and they've moved lower quicker for both CDs and non-maturity accounts. And that has contributed to the pivot and mix shift for our larger banks and credit unions. And if you look at charts of current deposit rates and kind of how they're dispersed among different markets, you'll see that high yield savings and money market accounts, they haven't seen much rate movement down like CD pricing has. And the top quartile, top half of CD pricing remains relatively in line with the advance rate curve. On the asset side, loan yields, I think they peaked in the third quarter of last year. They were down just a touch in the fourth quarter, but historically remain pretty rich compared to a couple decades ago, or over the last 10, 15 years, or about back where they were pre-Great Recession. We expect margins to continue to benefit from the repricing of very low rate loans, and reinvestment of low yielding securities, and then deposit costs expected to continue to move lower, and hopefully quicker than they probably have so far. Next slide, we take another look at earnings, but through a little bit different lens. We're comparing net interest income in 2024 to net interest income in 2025. Banks are on the left, credit unions are on the right. That left black bar is going to be net interest income last year, and how net interest income changed over the course of the year to what net interest income was for the year in 2025. So rate volume analysis used to understand why the net interest income changed. Was it due to volume, changes in balances, or attributed more to rate, changes in rates, or a blend thereof? On the left, we have volume, changes in net interest income based off of volume. And you can see that for banks and credit unions, loan volume contributed to a large increase in net interest income, and it matched about the change in cost savings from deposit costs coming down there on the right, those gray bars on the right. So volume effect, if loan balances grow, interest income is going to rise even if rates stay the same. On the rate effect, rising loan yields, increase in net interest income. And we kind of look at here the different factors for that. This view, it helps understand earnings drivers, evaluate pricing strategy, and helps manage interest rate risk. And on the next slide, we offer an analysis here at the bank, our return on average equity analysis. It's a DuPont style analysis available for members. It breaks down what is really driving return on equity and decomposes the underlying layers of profitability. You can compare your institution to two peer groups. We have some default peer groups set up, asset size, location, high performing group, but we have the ability to customize specific peer groups to fit your institution's profile. If you're interested, you can reach out to your account manager or myself, and we can run this one for you. We have some members that we do run this for them on a quarterly basis or semi-annual basis, as a reference point to kind of look at how they differ, for example, in loan rates for different types of loans compared to their peers. This is currently only available for bank members, but we are actively working on a credit union version as well. I'm going to go the next slide and just touch on, Drew shared a lot of information on delinquencies. And here you can see that same trend, more so at larger banks and credit unions with the black bars. Reserve levels haven't seen much movement at banks, and net charge-offs have been minimal. Net charge-offs were down compared to 2024 for larger banks, but higher for smaller banks. Reserve levels are going to be those gray bars in each chart, and the blue bars are going to represent net charge-offs. I have more concern on the credit union side, especially at smaller credit unions. You'll notice the black bars delinquencies. They exceed reserve levels, the gray bars, like they did leading up to the Great Recession. Net charge-offs have also been higher at credit unions, likely due to the more consumer-focused nature of their business. And we didn't show it today, but capital ratios have largely recovered to their pre-pandemic levels. So looking ahead on the next slide, expect margins to impress in 2026, but prepare for the turnaround. Share deposit retention and gathering efforts face ongoing headwinds. I've read an article recently that has talked about branch expansion efforts, especially for the largest national banks. A few years ago, Kansas City was listed as part of JP Morgan's 400 branch expansion plan. And if you look at the FDIC's branch deposit report as of June 30th of each year, you'll see that in 2025 was the smallest gap between branch openings and branch closings in our district over the last couple decades. And we have more deposits in our district that are going towards institutions located outside of our market, headquartered, I should say, outside of our market, but they have growing footprints within our district. So the competition isn't just digital and online, it's also down the street. And we expect that to continue. Drew talked about the economy, interest rate outlook, and investment in technology. Of course, geopolitical issues are present. M&A market is hot. The regulatory environment is favorable for that market and for those institutions looking to execute deals and grow through building scale through M&A activity. Access to liquidity and collateral capacity, imperative going forward. It's a continued focus for regulators. And that will take us into our next section on liquidity and funding strategies. We're going to stick with liquidity. As you are familiar, and we've talked about the environment that we operate in today, it looks nothing like the one that it did before the pandemic. Financial institutions now operate in a world where liquidity can move fast, markets can shift abruptly, and collateral is king. You could see in the previous slides that liquidity metrics came down just as quickly as they went up, with surplus cash primarily funding strong loan growth. Securities, they're no longer the primary liquidity backstop. Those cushions shrank as security portfolios fell in value, and they most remain in a loss position today. Deposits, they're more rate sensitive. They're mobile, they're expensive, which has led to funding stack composition. It's shifted. The old stigma around avoiding wholesale funding has changed to a more integrated strategic tool than maybe it did 10 to 15 years ago. And Federal Home Loan Bank's role in liquidity management is greater and more forward than it used to be. And that has been recognized, if you go to the next slide, Drew, with the Fed's recent statement and shift in their supervisory sentiment towards secured funding. I shared this in November, but the secured funding it acknowledges the bank's success in meeting those liquidity and funding needs of members during periods of market disruption, and then in response to the rapidly evolving interest rate and liquidity landscape that we've experienced. An institution's total liquidity position, not just on balance sheet, is the new era of liquidity. So establishing and defending a meaningful liquidity framework is a story to tell. It's a regulatory focus, and we can assist members as liquidity plans are revisited. Collateral management is paramount, and the ability to define, document, and defend that framework and tell your story is critical. And while we're on the topic of collateral and utilizing advanced funding, we do have two more poll questions. We can get those started. With the enhanced focus on liquidity by regulators, are you looking at ways to increase collateral capacity with the bank? Yes, we need to. We're working on it. No, or I don't know. And then what are your expectations for advance use in 2026? Increasing, stable, decreasing, or none? Let a few more answers come in. tends to be.
Leslie, did you mention that there's a bonus CPE for answering increasing? Just out of curiosity. Kidding.
Surprise.
That was a joke.
Looks like most, let's see, we can go ahead and I think close it. But expectations for increasing or stable primarily. That's what we're hearing from members. We've heard the expressed desire of members to pay down borrowings, but have acknowledged it's unlikely they will have the ability to do that. So they're getting more comfortable with holding advances to support their operating needs. And want to continue to the next slide. Collateral management again, liquidity, defined as the ability to raise money quickly at a reasonable cost without loss of principal. Collateral capacity at the bank allows you to do just that by converting that eligible collateral into capacity. Purpose is to align collateral strategy to support daily liquidity and contingency readiness. We have some next steps listed here. These are conversations we are actively having with members on each of their topics. One particular is allocating time to ensure policies allow for meaningful flexibility with all outlets, not just FHLBank Topeka, and collateral is pledged or ready to be pledged to secure funding if needed. The other is ensuring integration of Federal Home Loan Bank capacity into liquidity stress tests. If you go to the next slide, we've shared this before. It's an analysis that we offer for members. It's a crucial part of liquidity, and we run this quarterly for numerous members and customize it to fit their individual assumptions for their institution. This analysis helps identify if there's a need for access to liquidity in times of stress. We have low, moderate, and high scenarios, and demonstrates executable liquidity. So what you can execute today, and then if not, arranging access to additional funding facilities if not already established. We're going to shift a little into advanced funding. We've talked about on the next slide, deposit costs. Be mindful of marginal cost of funds. It's tough to find the balance between savings and growth. Deposit pricing spreads are very close to the advanced curve. We've had more conversations on this topic specifically recently. Members have reached out on modeling different scenarios with varying assumptions of rate change and deposit runoff and filling gaps with advances to see what that change in cost savings, what those cost savings might be, and then what they may be comfortable with letting roll off. And in doing so, data is important. So knowing what your deposit base consists of and understanding the cost of cannibalization is holding rates too high, and maybe some of those funds and single relationship accounts, those could go to kind of have some relief on deposit funding costs. And then Drew, turn it over to you for a little bit more advanced strategy.
Yes, thanks, Leslie. And I just wanted to point out that, about half of you in the room today answered that either yes, you do need to, work on your, increasing collateral and your liquidity position, especially as it pertains to funding options through us, or that you're working on it. And so, if you're in that camp already, then don't hesitate to reach out to your regional account manager, myself here in Oklahoma, Tony in Nebraska, Rusty in Colorado, Jeff in Kansas, because even just I've noticed a trend where even when that starts to become a something in the back of your mind, it doesn't hurt to get ahead of it. And we can send you that analysis to show, hey, even in a low stress environment and that liquidity tool that Leslie highlighted, here's where you're at. And I wouldn't be surprised if, on the iterations that we've run for our members over these last, couple of years, when they're in that camp, generally the low scenario is going to show a negative position. So there are ways to increase your collateral, maybe unbeknownst to you, some certain line items, and we can help walk you through that. or at least talk a little bit more about some tactical strategies to do that. So with that said, yeah, moving on to just some other funding strategy considerations for just, your upcoming, maturities that you have, loans, bonds, general balance sheet funding. First and foremost, ask yourself, what does the market have priced into the yield curve? Okay, we've already talked about that. We're going through this bull steepener, likely to then followed by a bull flattener. What do those situations look like for those upcoming maturities? Also, just the overall potential market expectations. Are they going to change? This might be a new normal. We're probably not going to see some ZIRP level of interest rates by the Fed, but they've done more rate cuts lately in the quarter four. Nothing so far for the year, but more than they did when they first started to tease the idea of an easing policy. What does your balance sheet need? What gaps do you have? Looking at those cash flows, and how do you need to fill them in your depository expectations on growth or declines, or how you're going to compete in this new space where money can move so quickly. Other liquidity considerations, loan demand, and your capacity to grow. When we talked about loan demand last year, most were expecting a pretty good year. Most ended up having a fantastic year. And we certainly hope that is going to be the case for 2026 for our members. But at some point, ebb and flow, the economy changes. Here in Oklahoma, I know we're a bit concerned about the oil and gas space because of losing Devon and Chesapeake execs, especially their executive team, down to the Houston area, moving their domicile down there. But the other little nuanced things are happening in the ag space, which we're definitely concentrated on in our district. Looking at those organic cash flows, I mentioned the strategy of trying to take advantage of those future cash flows, earmarking them, seeing what you have in the loan pipeline relative to what's left over. Can we add any other diversified assets such as bonds in the mix, which is always a great strategy leading into that sort of bear flattener that generally follows. So when you think about these incremental funding needs, you need to be asking yourself, you're shortening up or extending. I already mentioned, largely our folks are shortening up. How are they doing it? They're doing it by term. They're also doing it through our adjustable rate products. So anything that can help ride that yield curve when it comes to your cost of funds on a dynamic basis through wholesale funding with the Home Loan Bank can definitely help those accelerate that more so than the deposit space generally does due to repricing. So those optimal points on the yield curve, how they're going to function relative to your balancing of your interest rate risk position, your liquidity needs, and the market conditions, that needs to be top of mind as we move forward. Okay, improving earnings on the liability side, that's pretty straightforward, right? Take advantage of lower cost of funds, keep looking to diversify those funds through other sources. We are officially in that environment still where deposits are, moving pretty fluidly. I don't think there's any expectations of that changing anytime soon. AI can maybe even accelerate it further. So we really need to have a diverse set of funding there that we can utilize more so than just strictly relying on some of those very low interest earning deposit or paying deposits. Should you be, carrying your funding with us overnight on the overnight line of credit? Do term funding, adjustable rates? The answer is a combination thereof. I think that all of that has room for your funding needs going forward. Some of the terms will maybe work out great due to your interest rate outlook. Some might not. Keeping it short is more of the theme inside of about a 12-month term here lately based on member trends. Fixed or floating already addressed that. And then also advanced restructuring opportunities. We are in an environment right now where sometimes it does make sense to look at those restructuring opportunities with our lending desk, with your regional account manager, and see, is the juice worth the squeeze? We might have to pay a prepayment penalty, but honestly, based on our certainty of cash flows coming due in that time frame, maybe we can do a combination thereof. Also, we provide tons of different tailored funding solutions. So we're seeing more and more members that really hadn't used our funding historically. And so if there's education or anything that we can provide don't hesitate. Our number one goal is ease of use and education, making sure you understand what products would fit best with your balance sheet, having more tailored conversation with you on your specific needs. Our institutions share a lot of similarities, but at the same time, they also, every balance sheet is unique, and we want to have those more detailed conversations with you going forward. So contact us, and we can run this funding strategy illustration tool to walk through some of the scenarios that I just covered. Okay, moving on quickly to our housing and community development programs. This is the time of year where things are kicking off and funding is starting to roll out. AHP is our broader affordable housing program. It's the largest privately funded housing grant program in the United States. We've done a lot of fantastic projects with nonprofits and municipalities and communities across our 4-state district. We work with both public and private housing development organizations. So these are things that you can apply for. It's a competitive grant program, so we can walk you through the best practices when you do the actual application itself. If you're new to that particular program, Turnkey, that's our down payment assistance programs, HSP, HSP Plus, and HOPE. Just what we try and do to help those borrowers in your mortgage divisions that need that extra push. So that's been a huge demand. We're constantly coming up with new ways in which we structure these things. So don't hesitate to reach out to us if you have any questions on some of those changes. And then finally, just our the last two things here, our community advance products. That means that if you take out an advance that's the benefit of the actual project itself, and we're very, very flexible on a lot of this stuff that benefits housing in your communities. It also qualifies for commercial loans and farm loans and other economic development type programs. So it's a way to get a discount on that advance that you take out with us while also serving your communities that you already are well involved with when it comes to their needs. Lastly, our voluntary programs. This is the NAHI, the Native American Housing Initiative, the LEAP program, the Mortgage Rate Reduction Program, MRRP, and then the CARE program. These are all things that we do voluntarily with the funding that the more funding we do for you guys, the more that we've got money left over at the end of the day to do these types of things. And one thing I wanted to highlight that's kind of on, it needs to be maybe on the forefront of your mind. If you have folks at your institution that are involved in this sort of space, we do have the MSU Denver Affordable Housing Institute coming up. Whoop, missed it. Here to the left. We provide scholarships to these things, and so for the MSU Denver over these next few months, feel free to have you yourself or some of your folks in your at your institution that might be interested in that, and hopefully we can apply some sort of scholarship to help with that program. Turnkey, those programs, HSP rather, is going to be available March 2nd. So just here in a couple of weeks, and HOPE will be available March 16th. Mortgage Rate Reduction Program, that'll start up in April 6th of this year. LEAP in May 18th. And then applications for NAHI, so if you're working with any of the Native American tribes in your communities, that will open June 1st and will go through July 10th of this summer. And then lastly, AHP will open up July 1st and wrap in the end of July. Okay, with that, I'll turn it over to Leslie to wrap us up with our upcoming AMC and other housekeeping items for today's call.
Yes, thank you, Drew. One thing to add for HTD, next week, be on the lookout for an email with an announcement. We will share the funding that's allocated to each of our programs. So keep an eye on your inbox for that. So annual member conference, our 28th year of hosting the conference is this year. It will be held April 15th through 17th in Olathe, Kansas City area. Go to the next slide, Drew. What is the annual member conference? Previously known as the annual management conference. We changed the name last year. We've kind of broadened the audience for the conference. It's a 3-day education, networking, entertainment opportunity. We do get strong member attendance from across the district. We had over 150 individuals attend last year. Cost is very affordable, listed there. You do get a discount and a polo from the bank if you register before March 13th. There are Wednesday optional activities that you may sign up for if your schedule allows. We will have a round of golf that starts Wednesday morning at Falcon Lakes, and then a field trip to the Museum of Barbecue, and then on Wednesday. And then Thursday night, we have an outing at the brand new Rock Island Bridge. It's a converted railroad overpass that's pretty unique and unlike any other, I'm told, in the world. It's a the top reasons to attend the conference are listed here: networking opportunities with your peers, education, speaker lineup. We spend a lot of time on the speaker lineup. So the poll questions that we ask about your biggest concerns, about the challenges that you're facing at your institution, we take those, and that helps influence the speakers and the lineups and the breakout sessions that we put together. We also have, for first-time attendees, if you haven't attended before, they will receive a small gift and are invited to a first-time attendee welcome reception. And as I mentioned earlier, you've seen in the emails, we will draw one attendee from today for a free registration to AMC. And then if you attend our 2026 FI Lives, you will be entered to win a registration for next year's 2027 AMC. The green boxes here on the page kind of look like sticky notes. These are quotes from members on our conference that we put together. It's a great opportunity to learn and connect. On the next slide is a brief overview of the agenda. I mentioned Wednesday, if your schedule allows and you're interested in golf or the Museum of Barbecue tour and tasting, that should be great. We have that on Wednesday. Otherwise, if you can join us Thursday all day and half day on Friday, we do have a great lineup of speakers along with breakout sessions that are designed to tackle, like I said, topics that are top of mind for you. We do have a good focus on AI, innovation, stablecoin, asset liability management, and more. We have an economist this year. We also have an emerging leaders track, which we started a couple of years ago. This is related to the kind of shift in name to annual member conference for those individuals at your institutions that are kind of growing within the institution and have more management roles. This is a good option for them. I mentioned the Thursday night evening full attendance. You do get 8 CPE credits. And attendees that we get, it's a broad array of attendees from institutions. We get C-suite positions, finance team members, lending officers, mortgage folks, and other bank employees. If you go to the next slide, Drew, we can go ahead and launch that poll question. Last 2 poll questions we have here. What topics would you be interested in learning about from Federal Home Loan Bank subject matter experts at future events? At the AMC, you will hear from individuals here at the bank, one on innovation and stablecoin, our products, MPF. We will have breakouts for those topics from us, but we have a list here on where we can help provide education and insight for your institution. And then Drew talked about AI as well, and we're curious as to where your institution is today on its AI adoption journey. Already implementing, actively planning, exploring possibilities, early awareness, or no current plans. We just like to get a feel for what our members are, or where that focus is. And again, we have topics, our breakouts and speakers on some of these topics at the AMC. And it's hard to choose between which ones you might want to go to. So we encourage to bring more than one person from your institution if you are able. And with that, we can close the poll and we'll end it and wrap up here today. you did see some of these slides scrolling before we started. So the bank, we are here to help. We are here if you have questions about many different topics. If you have questions on lending, collateral, HCD, safekeeping, also here liquidity, general balance sheet management, here to help. Our resource center is listed, highlighted here. You saw that slide. Along with our member solutions page. We are working on that new page soon. Hopefully will come out. It will list all our tools and resources, provide descriptions, and have examples for you to reference. If you go a couple more slides, another slide, Drew, that you can then request for us to share with your institution. List of contacts, and then we will wrap up for today. One more slide, Drew. Thank you for joining us. We do have the next 3 sessions listed for the rest of the year planned out. We also have our topics. In June, we will have some guest speakers on. Chris Endicott will join us to talk about some changes and announcements in the MPF program. We will have I believe our chief credit officer on to talk about collateral lending values and collateral verification, best practices. I'm going to kind of continue on that collateral track. In August 27th will be a similar format and half-year update as we've had today. And in December, our CFO, Phil Backus, will join us to provide an update from the bank for 2026 in December. So there's a link there that you can click on when we send out the slides, or you can visit our website as well. I don't know if we have any questions or chat, but if not, oh, there's a link for the AMC for you in the chat if you do not already have it.
Yeah, and we'll get back to, we got some individual questions. We'll certainly get back to everybody on that. Thank you, everyone, for your time today. These poll questions, your participation is critical in our ability to fine-tune how we help you guys as members of the Federal Home Loan Bank here in Topeka. Really looking forward to everyone coming out to the AMC this year. That's going to be a fantastic event. Bring anybody from your institution that you think might have any interest at all, and we'll plan on seeing everyone in the Kansas City area then. If you have any other direct questions, you want to send us emails, you have our contacts, please don't hesitate to reach out there. Other than that, again, thank you for your time and enjoy the rest of your day.
Thank you.